Hi, everybody. So as we discussed in our last seminar, we're doing a special video today on explaining the Franklin Templeton fund issue in a simple, intuitive way so you can understand what happened and you can use that understanding to think about your own portfolio going forward. So this video will be the first of two things we're doing. The second will be a research piece that we do, similar to the last research piece we did for members, which will explain our current recommendations as to how we are thinking about the Franklin Templeton issue, how we're thinking about debt investments in today's market, etc., which will have more concrete advice in terms of what members can do for their own portfolios. But this will be a good first step in understanding the issues at hand. So let's jump into the presentation. Sorry. So to begin, we're going to do a quick recap for people that aren't familiar with what happened. So Franklin Templeton is a fund house which recently issued a press release on April 23rd. So that's Thursday night last week. And in that press release, they announced that 6 of their funds would be basically unwound. So we'll discuss what unwound means later. But the names of those funds are on the left-hand side of this presentation slide. And I've called out a few quotes here from that press release that will help us understand exactly what happened. So the first quote is, "There has been a dramatic and sustained fall in liquidity in certain segments of the corporate bonds market on account of the COVID-19 crisis. At the same time, mutual funds, especially in the fixed income segment, are facing continuous and heightened redemptions." The second quote is, "The events require these schemes to be wound up, and that is the only viable option to preserve value for unit holders." So specifically, the press release talked about limiting the ability to create, cancel, and issue or redeem units. So basically, no additional units can be issued, so no one can enter the fund, and no units can be redeemed, so no one can pull money from the fund. So this is something we'll explore as well in this presentation. But first, I want to understand some of the key points from the press release that will help us understand what happened. So I've bolded a few sections of the quotes. So the first is a dramatic and sustained fall in liquidity. So we're going to explore what that means. And the second is the heightened redemptions, continuous and heightened redemptions. So we'll explore that as well. And that'll give us a good understanding. But before doing that, I want to just briefly explain to any users that don't know how a mutual fund works. So essentially, a mutual fund pools together money from lots of individual investors, and it uses this money to invest it on behalf of the investors. So it'll buy either debt securities or equity securities, right? In the Franklin Templeton Fund's case, they bought debt securities. So what does this mean? So if a mutual fund gets a new investor, it suddenly gets more money in its account, right? And so it takes that additional money and it has to invest that new money also. So it needs to buy more of whatever it has in its fund, right? Now, similarly, if I own a mutual fund and I then sell it, I'm asking the mutual fund company to now repay my money. So it needs to take a little bit of what it owns and it needs to sell it so that it recovers cash from that asset. And it then gives me that cash in return for me giving back the units to the mutual fund company. So the implication of this is, if a mutual fund gets more money from investors, it has to buy more. If it gets more redemptions from investors who want their money back, it has to sell more of what it owns, right? So that is, in a sense, how a mutual fund works. And if we understand this dynamic, it will go a long ways to understanding what is happening with Franklin. Okay, so let's go back to that press release, those bolded sections, and let's understand them now with that overlay of understanding on how a mutual fund works. So the first piece I want to cover is continuous and heightened redemptions. So basically, in English, this means lots of investors wanted to exit the fund, right? So as we learned from the last slide, if investors want to exit the fund has to sell the assets it's holding, right? So it can generate cash to pay back the investors who are selling. So that means that the fund now needs to sell lots of assets. The second piece of the press release told us there's a dramatic fall in liquidity, all right? So you may remember if you've tuned into our webinars in the past, liquidity is a concept we've discussed a couple of times. And it basically, as a reminder, means how easy or hard is it to sell something. So if it's easy to sell something, we say something is liquid. If it's hard to sell something, we say something is illiquid. So when Franklin said there's a dramatic fall in liquidity, it's telling us that the ability that Franklin is seeing to sell those assets that it needs to sell is becoming harder and harder, right? So this is what's essentially creating the problem. It needs to sell these assets, but it cannot sell these assets. So why did this happen? So the first trigger was, why are investors wanting to redeem their assets? So COVID-19 caused investor worries on companies' ability to repay their debts. So why is this? Because businesses are shut, but their loans are still open. So, and you will see this in any loans that you hold also, even though COVID has shut lots of businesses, loans meters are still ticking. Even if there's a moratorium, that interest rate is still ticking away. So investors are growing concerned that even though the business is shut, it's still going to have to pay back its loans. How is it going to do that? So that's caused an increase in the number of investors that want to redeem their funds. At the same time, Franklin's funds had a higher proportion of their investments in lower rated companies. So bonds are rated by rating agencies much in the same way that you or I are rated by credit rating agencies also. So you may have heard of a CIBIL score. So like there's a CIBIL score for you and me, there are credit rating scores for companies. And Franklin's portfolio was invested in slightly lower rated companies than other funds that are similar to Franklin's. So investors got particularly wary of Franklin's investments and wondering whether they would actually be able to recover the money that they had lent. So why did Franklin do this, right? So generally, if you invest in lower rated bonds, you're able to get a higher rate of return, right? So this worked very well when the economy was good, because companies were generally paying their loans back. They could issue new bonds to refinance their old bonds. And so generally things were working smoothly. But when investors started seeing what was happening with COVID, they suddenly said, hey, maybe all these companies won't be able to pay their loans back, right? So Franklin was one of the funds that spooked investors more than others. Now, this may be true or not. That's the important thing to realize here, in the sense that these are judgments that investors are making. No one has a crystal ball saying, yes, Franklin's companies will not be able to repay their loans, or no, they will be able to repay their loans, right? No one knows for sure, but these are judgments that investors are making. And many investors judged that Franklin's funds would face more trouble than other fund houses. So that's essentially why we saw what happened with Franklin. So what's going to happen now? Because of this liquidity mismatch, right? Franklin needed to sell more assets than it could to satisfy investors' demand for cash. Franklin was forced to close the fund and say, no, we're not going to sell anything, and we're not going to allow any new investors to come in. The way we're going to deal with this is we're going to gradually unwind the portfolio. So what does that mean? That means basically that Franklin will return money to investors gradually over time. So basically, how is it going to do that? One is it will wait for companies to repay the bonds that it owes, right? So if a company agreed to repay a loan in or a bond, remember bond and loan are basically synonyms. If a company agreed to repay a bond in say 6 months from now, 6 months later, it'll repay the bond and that money will then go to investors 6 months later, right? Or if Franklin is now able to sell that bond, then maybe they'll sell that bond in the market and repay investors sooner. So basically, Franklin is going to gradually unwind this portfolio by either selling the assets when it can, when the market becomes liquid and buyers come back in the market, or it will wait for companies to repay their loans. Now, when a company doesn't repay a loan that it actually owes to Franklin is when you will see an actual loss happen in the portfolio. So if that doesn't happen in this case, investors will actually end up with a good return because they will be able to recover all of the money that was owed to the fund, right? And it just will take longer for them to recover that money than if they could just sell the unit in the market. But if a lot of companies are not able to repay, then actual losses will occur. So the biggest implication right now for people that are invested in Franklin funds is they cannot sell these units in the market and just recoup the investment. But it remains to be seen what's going to happen in the future based on how the companies that Franklin is invested in actually perform. So that in a nutshell is what we're seeing with the Franklin issue. And as I said, Bharosa is going to, for members, do a research piece on what the implications of this are and how you should think about this in regards to other mutual fund houses and debt funds that you may hold, and what our recommended strategies are for doing it. And like I said, does not mean that we think we've got a crystal ball. It's more about leading you guys to ask the right questions on your portfolios and working with your specific advisors or yourself to come up with the right investment strategy for you. For those that don't have a Bharosa membership, it's only 1,000 rupees for a full year membership. Recommend that you just check it out and get one, or working closely with a specific advisor to make the right determinations for you. So hopefully this cleared up what's going on in the market and gave you some understanding, and that's your best ally in working through times like this. So look forward to our future seminars. We'll keep you updated on in new developments at the club, and we'll see you next Sunday. Thank you.